President Daly, I do want to start right where Tyler was talking about, which is the coronavirus. Obviously, you have the district that faces closest to Asia, that is the port from Asia. What have you seen here in terms of the effect on the regional economy, and what impact do you brace for when it comes to the national economy?
So little impact yet on the regional economy. Most of the interest right now here is on the friends and family who are in China oftentimes and affected. The human toll is the thing that's most important on people's minds. But of course, people are at the ready. We're watching it in the regional economy. We have had a reduction in flights coming in from China into the San Francisco airport and along the western seaboard, but still a minimal impact economically on the regional economy or on the national economy.
What about the effect of if China's economy is already been downgraded by a lot of forecasters by up to a full percentage point? Does that knock on to your economy here on the West Coast and the full U.S. economy?
Well, you know, when it is the case now that if any major economy stumbles a little bit, then we all sort of sway. But the impacts are limited because think about viruses in the past or natural disasters. They have temporary impacts, but once the viruses go away, things are back to normal, there's a bounce back. And so I expect China to have a couple of quarters perhaps of weaker growth, but then bounce back once this has been resolved. And then that to have the kind of temporary impact on the U.S. economy and go away once things have been resolved. It bears further watching, of course. We're keeping a close eye, but right now I'm not looking for this to do anything material to our economy.
The market seems to disagree a little bit. This, over the time that this virus has been out there as a major news story, obviously we've seen huge swings in stocks, also seen an increase in the outlook for a Federal Reserve rate cut as soon as maybe September or July to look at the Fed's fund futures market. That seems a little out of kilter with your view of what the Fed may need to do here or the potential economic impact.
Sure. So the way I look at this is that this is yet another uncertainty. Now, we have faced over the last year and a half a wave of uncertainties. We had slower global growth, perhaps a hard Brexit, geopolitical concerns across the globe, and this is just another kind of uncertainty. Those are all headwinds for us, and we have taken last year 3 rate cuts that put accommodation into the system that made me I was supportive of those rate cuts, and that puts our economy in a good position to weather the storm, if you will. Now, if the uncertainties get worse or the virus is much worse than it's currently thought to be, or other things emerge, that could change the equation. But for right now, the way I see it is the cuts we have in place already, the accommodation, puts the U.S. economy in a good place to weather these storms.
I don't want to put words in your mouth, but it sounds like you're saying the market's a little bit ahead of itself in discounting a Federal Reserve action relative to recent events.
Well, I'm saying my perspective is that we look at a whole portfolio of risks. And on one side, we've seen the chances of a hard Brexit be reduced. The trade agreements have given us a little more hope that that uncertainty will come down. And so this is an uncertainty that's popped up. But think of all the headwinds together. There's some that are blowing less quickly or less strongly and some that have strengthened.
Look at your overall outlook, though, for the economy. Coming off a year where it looks like we're going to do about 2%, or we did 2% growth. What's the outlook for 2020 as far as you're concerned?
My own personal outlook is for us to grow at roughly 2%, maybe a little bit faster. That's above my estimate of what's potential in the United States. So I have my estimate of potential at 1.8. So this is a little above trend, which is going to continue to put pressure on labor markets and continue to move inflation gradually back up to our 2% goal.
I guess I can ask you this question with a blink in an eye, which is monetary policy appropriate for that outlook where it is right now?
The way I think of it, it is that we've got policy in a really good position that delivers these outcomes. So the way I start when as a policymaker is we have 2 mandates, full employment, price stability. We're missing on our 2% inflation goal, and the labor market looks to have more room to run. So if you put more accommodation in, which we did last year, that pushes the economy, continues to have the economy grow above trend, despite the headwinds we face, that, to me, is appropriate policy.
I don't know that people know this, but one of the things you bring to the table as president of the San Francisco Fed is your expertise in the labor market. How low can unemployment rate go?
We're still finding that out. So if you asked almost any economist, even just 3 years ago, they would have said 4.5 before we'd really start to see inflation take off. Now we're down to 3.5, mid-threes. Think it's could be even lower. So I think we need to learn what full employment in the United States is experientially, as opposed to guessing and then stopping short of really fully realizing it.
How do we do that? We just let it run?
Well, we keep our eye on two things. It's always a balancing act, right? We have two mandates: full employment, price stability. So we're looking at that inflation goal, and we haven't achieved that yet either. So if wages aren't rising rapidly, pushing inflation, price inflation up, then that gives us room to explore and experientially find full employment.
When you look at what's happening with wages right now, you don't see a tight labor market then?
I see a labor market that's tightening, and we see that attracting workers in. I see employers looking for all types of novel ways to attract employers and retain employers in their businesses. But I don't yet see it reflected in wage increases that are so substantial that I believe it will push price inflation over our 2% goal. And so for me, it's a strong labor market, but not one that is historically tight as the historically low unemployment rate would suggest.
Let me ask just two very quick questions here. What are the risks if you get this wrong to the downside, for example? Are you concerned about where the stock market is right now and how high it is?
So the stock market is a reflection of people's optimism for the future oftentimes. And I think one of the things that's buoying the stock market is the sense that we're continuing. We're in the 11th year of our expansion. And when I talk to my contacts, I spend a lot of time talking with my contacts. Talked to them last year, 2019. There was an air of pessimism, a lot of concern, especially early in the year. But as the year went on and we took the accommodation we took for the monetary policy, they started to grow more optimistic. Early in 2020, they are optimistic about 2020, and they're starting to take some of those plans they had shelved and move them into activity. So I think that's what the stock market's really reflecting, is that we are in 11 years, but we may have finally reached the point where we've taught people expansions do not die of old age.
It's a good place to end it. President Daly, thank you so much for joining us here.
Thank you.